Hello, everyone, and welcome to one of our knowledge transfer sessions. Today we're going to be going over a topic, or really an observation I've run into throughout my career. It's how the average person can beat the average financial advisor. I'm in the heart of tech country. My practice here is in Bellevue, Washington State, and so I've dealt with people who have had Costco RSUs, Microsoft RSUs, or really Costco stock, Meta RSUs, all sorts of company stock, and all sorts of different people who have invested in their 401ks. And I found there are certain groups of people who will typically beat the average financial advisor. And I think it's a good thing to understand how the average person does beat the average financial advisor, so you can understand how you want to interact with the financial services industry. So let's talk about what I would personally find an interesting topic. How does the average person beat the average financial advisor? Before we get going, a lot of this stuff is going to be summarized. Information has to be treated as general in nature because, everyone's situation can be a little different. Variables we choose can be different, and just making sure that you understand that today's topic is general in nature, basically. A little bit about myself. I have more than 18 years experience in the financial services industry. I've worked everywhere from a bank to an insurance company to running my own practice. I'm held to the fiduciary standard. My office is in Bellevue, Washington State, next to Overlake Hospital. So most of my presentations are going to be more Washington State focused because that's the state I live in. So what we're going to talk about today is we're going to talk about the concept of, does the average person win? Is that actually a true statement? And then we're going to talk about diversification and how that really changes this statement. And then we're going to talk about how we handle this in our practice. How do we handle this information? But this basic question here, does the average person win? Well, I don't know if people realize this, but how you invest is really tracked. There's lots of studies that are looking over, your decision processes, how well you're doing as a general public, things of that nature. And when the tracking occurs, I've noticed there's something interesting about the research, and I'll walk you through this. And this isn't a bait and switch, but a lot of the research would actually suggest that the average person does significantly worse than the average financial advisor, like 2 to 3%. I've seen some studies show 1%, and this is net of fees as well. I've always gone, well, but when I look at people's retirement statements and then I look at some of the things I offer, realistically, if they were following the path they were on, like say an S&P 500 fund, they would outperform me. So why are people doing so much worse potentially? Okay. And so I thought I'd explore this concept a little bit for you and kind of see if you can see where the bait and switch is, basically. And let's compare this to, that rate of return you saw on the previous screen, how an advisor should beat the average person versus an index fund, right? So if you go to Vanguard, you buy their S&P 500 ETF, you would see that the 10-year return is about 12.64%. And if you compare that to the previous screen and what the advisor was getting over someone, you would see that someone who bought that one fund would beat the advisor by at least 5% over the last 10 years. And if you bought a growth fund, you're 7% or more. And me being in the tech world right now, where I have a lot of younger people who are highly affluent, making pretty decent money, they're typically buying tech funds, they're typically getting company stock, and they're dominating what would be more average returns that an advisor would be getting you, basically. And even if you go to Vanguard's Life Strategies funds, which these are funds that are more like robo-advised funds designed to hit a target risk, you're going to see that these are clearly underperforming the indexes. And so if you really look at the difference in language between an advisor and the average public, you're going to start to see there's this difference here of rates of return and why you might be beating the average advisor. Now, let's talk about how you make decisions about investing. Once again, this is tracked. And studies would suggest that you are going to make your investment decisions very simply based upon snapshot information in about 6 minutes or less for the majority of trades. So when we talk about things like alpha, beta, all the different volatility statistics, the average person's not going to be going into that. They're going to look at major news articles. They're going to look at rates of return, fees, things of that nature. And that's where the majority of people are making their decisions. The other thing when you're making your decisions is you're going to see that the majority of decisions are going to be around in the employer retirement plan. It's the number one percentage by percentage area of someone's overall portfolio or their investment is their employer retirement plan. So when you gate these decisions, what you're going to find is that people are going to simply look at the information like you see on the screen right here and make their decision. Okay, and this comes from Voya. This is the Washington State Public Retirement Plan. So you can find this information right online for the Washington State's Public Retirement Plan. And if you look at the Public Retirement Plan and you're making your information simply based upon a snapshot of data, you're probably going to choose the option here that has the lowest fee, that has the longest historical returns, and then you might diversify a little bit based upon belief around markets, articles you read, things like that, basically. But you're going to make your decision very simply, and the majority of the investing decision is going to be based around information like you see right here. And so if you think about this process the average person's doing, you have your paycheck is protecting you, you're in your working years, you're quickly and simply making investment decisions based upon this basic general information right here, and you're probably choosing this fund right here. And lo and behold, just like previous screen, you're probably choosing the US large cap index or the S&P 500 and potentially earning around 12% rate of return. And the statistics showing that the average advisors, being the average person, is showing that they're getting 4 to 7% rate of return. And this difference in language is going to be, I would argue, a major source of conflict between the general public and the financial services industry. This right here. And I would argue the average person is actually beating the average advisor because of this process. But there is a gap here. And this is where the gap is. And this is where the language and the hard feelings occur, is this concept around diversification. Okay, because if you were buying if you went through that process and you bought that US large cap growth fund, well, there's lots of statistics showing over the last 10 years that dominated all other asset classes. And so the second you bought anything else, or the second an advisor diversified you, the second you chose other asset classes, if we use the past 10 years of history as an example, you got worse returns. And go back to that Vanguard Life Strategy Growth Investor. It's a fund you can buy yourself. It's more of a robo-advised style. It's designed to be well diversified and very mathematically intensively chosen as to how they're doing their model. It's losing by 5% to the basic S&P 500 fund, which is also diversified across 500 stocks. And so this problem right here is where the crux of where the problems tend to occur. Because if you look at that, once again, that Washington State Public Employees Retirement System plan through Voya, what if you chose a target date fund? What if instead of choosing the U.S. large cap equity fund, you're like, I'm going to retire in 2035. I'm going to choose the option that aligns with that is automatically kind of robo-advising me and diversifying me along the way, and is designed based upon generally accepted principles to be an appropriate retirement portfolio for me. And you would automatically, by choosing that one option, you would hurt your rate of returns by about 5% over the last 10 years. And that's not a bad option, right? That's actually not a bad rate of return. But if you chose the U.S. large cap index fund, you'd materially have much greater returns. And so if you look at this basic problem of diversification and choosing different strategies is the problem in the financial services industry right now. And so there's a concept called risk tolerance. If you ever work with a financial advisor or in the financial services industry, one of the major compliance standards is someone's risk tolerance. This comes from investor.gov, and it's basically a description of risk tolerances for someone. And once you start talking about risk tolerance, you're going to start talking about diversification. And once you start talking about diversification, you can't use the data, the past performance data, because it doesn't equal future results. You have to start choosing other asset classes. And when you choose other asset classes, if past history repeats itself, which it has for the past 10 years, or really since 2008, you find that the average person gets better returns than the average advisor based upon the situation right here. So how do we handle this in our practice, right? So I have had to run into this problem ever since I left college. Whenever I hire a new employee or work with them, one of the basic questions I ask them is, how are you going to beat the S&P 500? I'm always curious to see what their answer is going to be, because it's a basic problem here. And so one of the first things I do, just like this video right here, is I'm trying to educate someone around diversification, the benefits and the problems of it. Okay. I think risk tolerance questionnaires have been way overused in the retirement services industry. When you say you're moderate, you've automatically signed up for those lower returns. Now, that could be totally in your benefit, right? You might be a moderate investor who has lower volatility or needs lower volatility, but there should be discussion about that, relative rates of return and what could potentially happen. And you can't guarantee results, and the past doesn't predict the future, but it is the best benchmark we basically have for the future. Some people are doing a great job. They're working, they're doing everything they're supposed to do. And there's a major conflict of interest in the financial services industry, even for fee-only advisors, because to earn a fee, sometimes you have to tell people to do something different to make them feel like the fee is worth it. And that's a problem, because sometimes you should just keep doing what you're doing, and heck, maybe you don't even need to pay a fee. If you're comfortable taking a risk, you should consider taking it once you're educated. I know people who create generational wealth by staying in concentrated stock positions. There's clear risk there. We have the Enron problem, but there's also clear benefit. So, you need to have that in the back of your mind. And then a lot of our practice is focused on diversifying against the S&P 500, not trying to beat it, basically. We typically focus on retirees or soon-to-be retirees because you typically will need diversification, which means we can now deploy all our models and even beat potentially all those other models out there. We're really focusing on time-poor individuals. A time-poor individual is someone who could do that 12%, but actually can't find the time to do it. And even if you're paying someone a 1% fee, it fixes the problem for you. Behavioral finance is a major problem in the financial services industry. Just because I showed you all this data doesn't mean you can press the button. That's what I call behavioral finance. There could be emotion, anxiety, stress. That's my big job to help fix that. And then some people just want concierge service, right? It's just like the person who wants to, go to the really nice hotel and have someone just taking care of things for them. That's a big part of my job as well. We also have some strategies that could actually compete with the market and potentially beat it. Direct indexing with tax loss harvesting, concentrated equity, private equity, and hedge funds. I don't like to align my practice with beating the market, but with those people who are more growth oriented, once I've kind of figured out that that's their tilt, these are types of things you can deploy to actually potentially beat the market. Bottom line, though, here is if you had this presentation right here, the question is, what is your diversification plan? Because if you have an income-based diversification plan, i.e. you just go to work every day, or you have Social Security, pensions, annuities, you can take more market risk realistically. You could look at just putting all your money in the S&P 500 and potentially beating the average financial advisor. But there are other diversification plans, asset allocations, like those target date funds I showed. Sometimes you just need some money on the side called a sleep at night hedge. Or some people just don't even want a diversification plan. They want to go for full returns all the time. But this really was a conversation around diversification, how it affects rates of return, using the concept of how the average person beats the average financial advisor. So we're here to help. I hope this video was interesting to you, giving you an interesting topic or some interesting thought processes of the financial services industry. If you're working with a financial advisor, I hope that it gives you kind of an idea of how they approach their world, basically, to have more robust conversations with them. But if you want help or you have any questions, feel free to reach out to us. We're happy to educate people, talk with people, or include people in our practice. Thank you, and I hope you have a good rest of your day.